In today's video, I'm going to show you one of the biggest mistakes that investors are missing out tons of opportunities on great cash flowing properties with wonderful appreciation. And it's all going to begin right after this. Hi everyone, Josh Tavares, investor and realtor with eXp Realty covering the Greater Toronto Area. It would mean so much if you can help us out and hit the like button, hit the subscribe button, and hit the notification bell to get updates on our newly uploaded content. And if you're thinking about investing in real estate with great cash flow, great appreciation at low price points, hit the link below and you can partner with us to invest in US properties, something that is going to be super hard to get the same returns here in Southern Ontario. And without further ado, let's begin. Now, one of the biggest mistakes that I'm noticing with investors, and it's not the lack of information, there's a lot of information, there is of course a lot of people with analysis paralysis, but one of the biggest issues is the HELOC. And it's not essentially of using the HELOC, is the thought process around the HELOC. We have investors missing out on opportunities because they're using their HELOC, which is their home equity line of credit, removing that from their home and using that to purchase rental properties. The issue is they're looking for properties that are not only going to cash flow with its own mortgage, utilities, insurance, property tax, and so on, but they're also using the analysis to have that property pay for its own HELOC from the primary residence as well as everything else. Now, I completely understand you ideally want to have your rental property pay for everything and of course cash flow, but it's going to be super difficult with how much appreciation has taken on in the Southern Ontario market. We're talking about properties that a couple years ago that were about $200,000 to $300,000 are now $7, $8, and getting closer to that $1 million price range. So you may have to finance the HELOC payment on your own and have the rental property do the rest. We know different investors who said no to rental properties that were fantastic, all because it couldn't take on the additional funds from the mortgaging from the HELOC of the primary residence, and it was negative cash flow, a little bit of money. Now, I think that's just the cost of doing business, and without that HELOC, you essentially won't have a rental property and be able to scale and grow from there. So if that's something that you're gonna have to pay a couple $100 every single month, then I think personally that's the best way to go about it. You don't wanna miss on tons of cash flow, appreciation, equity built over the years, all because you couldn't get this one property at this time to pay for it. Remember, down the road, rents are going to increase. So over time, it can take on that amount. So keep note of that. If the cost of paying for an additional mortgage or line of credit is going to be too expensive for you, then it's going to be really, really expensive when a massive maintenance occurs, such as roofing or a huge plumbing issue happening in the basement. When looking for a property, you want to make sure the property is going to be able to pay for the mortgage, maintenance, vacancy, insurance, utilities if need be, and any other costs associated with the property. If it can do that, then you've got yourself a great property that if it is able and you are able to find a hidden gem that can pay for the HELOC, of course, definitely go for it. But if it can, I wouldn't kill the deal just for that. And for those of you in our database, you'll see when we send you rental opportunities, we give you a full breakdown, including any associated fees that'll be associated to that particular property. Remember, in the very beginning, you might be a couple $100 negative cash flow alongside with the mortgage HELOC if your property is paying for that and you'll be paying the rest. Over time, it's gonna not only break even with that payment, but also cash flow. Our first rental property was below market value. After tenants had left, we were able to increase the rents, including renovations involved as well, to about $700 to almost $800 in monthly income. That's substantial, and that could happen over time as rents continue to increase. Remember, real estate investing is a business. You don't want to make a harsh decision and say no to a property that could have led to tons and tons of equity and led to multiplying and purchasing more and more properties, leading to a much better lifestyle. Imagine saying no to a property that could have led to 10 properties down the road, all from the burst strategy and being able to attract partners down the road. That would be a huge missed opportunity. And on these particular deals, we're going 50-50. Essentially on our end, we're the knowledge partners. We're going about taking care of the property. We have access to the team, and we've done this with the success that we've had with our credibility, as well as adding on to that our partners who are working alongside with us who have have access to funds, but not sure how to go about real estate investing. So that's why it's a wonderful synergy between us as the knowledge partner and our partners as the capital partners. And what I love to do with our partners is show them a breakdown of what the property will be worth in terms of appreciation, cash flow, equity, and the potential of those properties being able to help us multiply through refinancing and duplicating through different strategies such as the burst strategy, to tell them, hey, your couple $100,000 you've invested into this property can actually lead to $1 million, if not more, through everything associated with appreciation, cash flow, equity, and being able to multiply at such a quick time. Now, personally, it's not worth missing out on that $1 million plus opportunity. You're better off just taking on that cost and being able to have your money work for you while we partner together, buying you fantastic properties, and you sit back and have the returns and cash flow work for you. Personally, it's just the cost of doing business and something that we can all work towards as we work with our partnership to be able to get that appreciation and value. Like I said, many of our investors don't have the expertise, so that's why we come in, make everything work out really, really well, hands off for our partners so we can get them return on their money. The properties that we're purchasing has great cash flow, equity, appreciation, and you're able to duplicate at a strong price point. Because we're purchasing it in cash, we're able to get a loan within 6 months, right? So at that point, we're able to build a relationship with the lenders to show that we've done this on our own, that we're able to duplicate and scale much quicker than in Southern Ontario. We're looking at properties, especially in the Niagara region, about $750,000 to $800,000. After you use your HELOC, you're only going to have enough for one property that you won't be able to duplicate for probably about 5 to 7 years. So it's going to be really tough. In our market, we're always looking about scalability, cash flow, appreciation, and getting the best return for our partners. I hope that video was super helpful and insightful and prevents you from making a massive missed opportunity. I'm Josh Tavares, investor and realtor with eXp Realty. And once again, if you guys are looking to invest in real estate and want to partner with us on US deals with low price point, great cash flow, great appreciation, click the link below and let's work together. Thanks so much for watching, everyone. Take care.